All right. Hello, traders. This is you've got options for Income Navigator. Today is Wednesday, October 16th, 2024. Speaking of Wednesday, I do have the Monday, Wednesday, Friday short SPY put campaign that I need to enter, and I do enter these trades manually. I mean, there is a bot actually for Option Alpha, I believe, that we can probably look into setting up so that I don't have to. Sometimes I don't necessarily forget, but I overlook and I think, yeah, I'm going to do it. I'm going to do it. And then I end up not doing it later in the day. So having a bot would be really helpful to just get that out of the way first thing in the morning. I don't try to time the market with these short spies, which um, selling that spy put would probably be a lot more advantageous yesterday rather than today. But I just put them on Monday, Wednesday, Friday, keep it going. And, sometimes I sell high, sometimes I sell low. The goal is to capture 80% of credit that we're collecting on entry and get out of the trade and just keep the chains moving. Let's have a look. What do we have going on today for SPY? And I did share the automation. So when I put on the trade in the SPY, I do a custom order that automatically enters not just the opening trade, but I also have an order to close out the trade once it reaches 80% of max potential value or the credit that we collect on entry. I'm just looking right now, the SPY in December 20th expiration with 65 days to go. This is where I'm at right now. I'm still adding to these 20 expiration cycle with 65 days. Um, last, the most recent tranche I did was the 460 strikes. I really don't like to overlap these, and I try to avoid having to sell the same strike again. So right now, the 460s are at $1.33 to $1.34, and the 465s are $1.41 by $1.42. So I think I'm going to go ahead and sell the 465s. It's a little bit more than what I normally collect. If you look at the past trades, um, the average price where I sell these puts is at about $1.30, maybe to $1.33 or something like that. So selling these puts with 65 days for about $1.41 is not terrible. We're just going to try to get out a little bit, I guess, sooner. So right now I see the mid price at $1.40. One great thing about these SPY puts is that bid-ask spreads are super tight. The only thing that I kind of don't like is that sometimes, and this is one of those times, we don't have any strikes between 460 and 465. It would be really helpful if we had a $1 strikes between these 460s and 465s, but 465 works as well. I'm going to put the order in. I'm selling to open December 20th, 465 put, and I'm automatically going to enter an order to buy to close these as soon as they lose 80% of their value. And I also have another custom order template where you can order or you can put an order to sell to open and automatically send two more orders. One is to buy to close at your profit target, and one buy to close at your stop loss, right? When if the value of the put increases 300%, that would be your stop. I don't really like to enter stops right now because we're at all-time highs or right around that level. And, if we pull back 10% and the market, if volatility increases and that puts these puts at a price where I would normally stop out. Before I stop out, what I like to do is I like to look at the chart, understand the context, how fast are we moving? How much have we moved in, whatever the time frame is. Maybe it's in a week, maybe it's in 2 weeks, right? How much is volatility is playing a role in the price of these puts going higher? So I like to use that human element, right, to determine whether or not I want to stop out. Maybe I'll consider taking the shares and just wheeling them the hell out of here, right? Maybe I don't want to deal with the wheel. I just want to get out because things are, whatever. So before I stop out, I would like to understand if I want to stop out or if I'm going to commit to taking shares. But taking shares is most definitely one of the ways I go about managing these trades, and it is in my trade plan for short SPY put campaign. I know that somebody asked me before, I've answered this before, but as a general guideline, right? Like if you're doing this trade in a large account, you want to look at the notional value of the put that you're selling. So 465, right? The notional value for this contract is $46,500. If you are considering taking assignment on these puts, you want to have the cash in the account available if and when you need to take assignment. Don't think that, oh yeah, I'll take assignment, but in the meantime, I'm going to use this money elsewhere. You have this capital tied up in something else. Now you're facing an assignment. You're forced to either sell something that may be at a bad uh, price where you don't want to liquidate to free up the money for these short SPYs, and you don't stop out because you thought that you were going to take assignment. You have to be pretty clear. Like if you're going to take assignment, make sure that money is available. If you're not going to take assignment, then when you reach your stop, don't negotiate. Don't ask me. Don't ask Tom. Don't ask anybody else. If you hit your stop, you just got to stop, and sure, you can roll out for more time and blah blah blah, but rolling out for more time is it's equivalent to just taking a loss and opening up a new position at a different expiration, at a different strike price, and so on. So really not gaining anything by rolling out in time to save that one position that is in trouble. So I enter orders right now to sell to open and automatically buy to close at 80% of that credit. So I sold a 465 SPY put in December 20th, expiration for $1.41. And I'm going to post this a little bit later today in the Discord alert channel. So that's done. I have a number of puts in SPY, and nothing has been coming off. The last time I closed a short SPY put was, bear with me 1 second. The last one closed September 25th. There was actually 1, 2, 5 of them closed on the same date, right? So since the 25th, which has been like 3 weeks, volatility has been firm, right? Rising a little bit, falling a little bit day to day, but right now we are seeing volatility pretty firm, and it's increasing, so to speak. If you want to measure out of the money IVs to closer at the money IVs, and it makes sense. We do have an election coming up soon, so markets concerned, and you can see that in the front month VIX futures contract, which is higher than the back month. So the market is concerned about near-term volatility rather than farther out in time. So I think that things are a little bit slow. There's not a lot of exits out of these short puts. So that's why you need to have a good plan and understanding. If you are going to take assignment and you keep adding positions, you need to have the reserves to do it. If you don't have the reserves, or if you're going, for example, if you have $1 million account, and let's just use information that I have. I have right now, without the position that I just entered today, I have 19. So with today's tranche, I have 20 short SPY puts. They are pretty much, some are in November 15th expiration, some are in December 20th expiration. And these 20 tranches, I'm looking for a average notional value of these puts. Average price 45. So an average notional value is $45,395. So we're going to do 45,395 times 20, right? That's $907,900. So if you're doing that in a $1 million account, you're almost at 1x notional value to your net lick, right? In a $1 million account, you're holding $907,900 worth of potential assignment. If you were to take assignment on all of the short SPY puts, you're close to 1x notional leverage in your account. So one way to go about it is maybe if you are considering taking assignment on 1x notional, and you keep adding new trades, so anything beyond these 20 positions, you definitely want to use stop losses. Like, you don't want to hold 30 positions. I don't think that's going to be the case. I think the most I've ever held was like 20, probably up to 25 tranches at most. And this is usually in the times of, higher implied volatility, where it's not that we don't get the theta decay, it's just that time passage or theta gets replaced with implied volatility, right? The time didn't stop. It's just whatever options lose due to time, they make up for it with an increase in implied volatility. So losses due to theta get replaced with gains due to IV. So again, holding in a $1 million account, holding 20 positions, you're at 1x or so notional leverage in your account. Anything beyond that will definitely need a stop loss. Which are going to get stopped, which are going to get assigned is completely up to you. I think what makes sense is, you could pick your highest strikes and maybe stop out of those. If you had to choose like which ones to stop and which ones to keep, I would probably look to stop out of those that are highest strikes, right? You don't want to start getting assigned, at the highest level. You say, you know what, if I'm holding 25 tranches and I'm only going to get assigned on 20, the first 5 will have to get stopped out. And if the market continues lower, the following 20, I will most definitely take shares, because you're going to get them at a much better price. Like, for example, right now I have, between all of the puts that I'm holding, the lowest strike I have is 415, and the highest strike I have is 500. So if SPY or SPY was to go down to 500, right, I would have to think about it. Do I want to take assignment at 500, which is, a decent pullback? But if we're going to see more, I would rather, if I wasn't going to take assignment at 500, maybe I'll consider getting assigned down from 480 and below, right? From 480 and below, that's about 100 points below where we are right now. So that would be close to a 20% pullback. So anything below 20% from current price, I'll consider getting assigned on. Anything above that, I would consider stopping out of. There's no one right and everything else is wrong way to do it. It's just, you do what works best for you. You get assigned on whatever you want to hold. If you think, SPY is going to zero, then stop out of everything and don't consider assignment. I'm not here to tell you what's right and what's wrong. You have to figure out. I'm just going to tell you, how I think about it. And, you could agree, you can disagree. It's all good with me. A comment from Craig saying a set and forget stop loss is bad if we get another August 5th. It's not bad. I don't think it's bad. It would be bad if a set and forget kind of a stop loss is only situation where it's bad, I think, is that something like a 9/11 happens when an exchange is closed for 5 or days or 2 weeks or whatever, and then we open 40% lower because your stop loss is useless, right? Your stop is going to get triggered, but then remember, stops turn into market orders. And then, if we open 40% lower, well, guess what? Your stop was way higher. They got triggered. Now you have a market order and you're going to get, stopped out at whatever the market price is. And odds are, if we're opening 40% lower, the bid and ask spread is going to be so wide you can really get screwed out of your position. So that's the only really um, bad thing about stop losses. So I'm not a big fan of putting in automatic stop losses. And just to touch on August 5th, I had 9 positions stop out, and 8 of 9 were stopped out on Friday the 2nd. So we didn't even get to the 5th. I had already stopped out of eight 8 out of 9 positions, and then the ninth position was stopped out on the 5th, and it was within my 3x credit stop loss. So no positions were blown out, and nothing like that happened. So um, I don't think that it's as bad as if you were holding some super leveraged contracts like ES. Jay is asking, how much BP does it take in a PM account to hold one SPY shares? I'll tell you right now. If you want to model this trade, you want to place in a analyze tab. You do SPY, and then you hit the ask. Let's say if I was to buy 100 shares at the ask, bear with me. So I buy 100 shares, and BP right now is $49,406. Is that right? I'm not sure. Let me check. The broker, so in a portfolio margin, right, the broker is going to look up and down 15%. I believe for SPY, yeah, it is up and down 15%. And if you're to buy 100 shares at 581.17, right, it's 58,000 notional, but the broker is asking for $49,400. Right, they're looking at what would your BP requirement, what would you have to hold in your account to be able to hold these 100 shares at a minus 15% slice. But you can utilize leverage if you want to hold these SPY shares. You just again, more leverage, especially when market is fallen, because it could continue to fall. If you are using leverage, you need to understand how much leverage, how much more additional capital you might need. You don't want to get squeezed out of your position. You know what? Charles saying it takes 87,000. I'm not sure why my Schwab is showing me a BP. Let me tell you. If I was to confirm and send for 100 shares, yeah, I'm showing the same thing. So the Analyze tab showed me BP effect of, oh, actually, sorry, it's my fault. The BP effect was positive. So if I was to buy 100 shares of SPY, I would actually gain almost $50,000 in BP. But if I was to buy 100 shares of SPY at market, my buying power would decrease by 87.15. So very little to put it on, but keep in mind that you want to account for notional value, because if you're going to take the shares, and you could get stuck with these shares for 3 years, right? I'm not saying that the market's going to go down or up or how long it's going to take, but what if you go in like this brutal bear market for 2 years, right? Where if you're committed to holding these shares, yeah, sure, you could sell some covered calls against it. Maybe you can sell covered strangles against it, right? And I think that's a really one that I like a lot, right? If you bought SPY shares at one price, it continues to go lower. You have more short puts. Now you're selling more calls on top of that. So you're either going to get called out of your shares or you're going to get put more stock. Great, right? As long as you continue to want to own SPY in the long run. So I think that's a really good one. But so you definitely want to use notional as a guide, not, a broker is asking only for $8,700. You spend all of your capital. If you keep your BP that's available, very tight, if things don't really bounce or head back up soon, you can get potentially in a very difficult spot. Yeah, covered strangles are, if you guys are interested in covered strangles, we can talk about that. That's a really good one. I've used it before as a repair strategy, so to speak. I did this with Amazon. I did this with a few other Apple, right? I'd sell a put, stock went down, I got assigned, I sold more puts, and I sold a call, right? Selling a put and selling a call, that's an out of the money strangle. You can do it at the money, it would be a straddle. It doesn't matter, strangle or straddle, but the idea is you're selling more premium. Either you're getting called out of your shares or you're getting assigned more shares. And then if you get assigned more shares, you can sell another put, sell two covered calls. Again, at some point, you have to believe that at some point the price is going to go back up. So, yes, you're potentially giving up all of that upside, right? So, because I know that anybody that is against covered calls, they'll come out of the woodwork saying, well, selling covered calls is a terrible idea because you have all the downside risk and you don't have any upside reward. I get that. But if you didn't want to really, get stuck with the shares in the long run, one way to get out of these shares is by selling an out of the money covered call, and for giving up, quote unquote, all of the upside, at least you get to collect some premium. And that'll get you to where you want to go. And your goal was to never own the shares to begin with. All you wanted to do is just sell a put and collect the premium, but you got assigned. Now you have the shares. What are you going to do with it? You can wheel out. How are you going to wheel out? Either, you sell a covered call or you hold it for however long until you feel the upside is over and then you sell it anyways. But yeah, I've done that before. I like it only on stocks that you would be willing to hold in your retirement accounts for a longer term. Like if you have a high flying, um, some pharmaceutical stock that is the hot thing right now, even though there may be a lot of premium and implied volatilities through the roof, I really wouldn't want to do something like that, because if you get stuck with the shares and it goes down for the next 7 years and never recovers, well, that kind of sucks, because selling covered calls way below your cost basis, now you guarantee yourself a loss if this thing was to ever bounce, right? You also want to keep track of your um, cost basis, understand where it makes sense or at what level it makes sense to sell a covered call, so that you're not selling a covered call below your cost basis, and in the best case scenario, you'll just have a smaller loss. You don't want to do that. All right. Let's talk about the butterfly that I have on the Option Explorer screen, this is a trade that is uh, 12 days already in the making. SPX is the underlying. It has gone up about 0.75 standard deviations. So, to say that we're moving with some significant speed, we aren't. I mean, we're moving within one standard deviation, which, is not too fast. We are within the expected range, so to speak, even though we did pop a couple of days ago when we hit an all-time high on SPX. We were just outside of one standard deviation. So the pressure, so to speak, is to the upside. And for this trade, what I did was I started this trade, and this is a trade number 3003 for those that want to go and look on Discord in the Trade Alert channel. You type in the search box 3003 and you will get a link to the post where I posted the trade. And then every follow up, there's some questions, there's some answers, there's more follow up about this trade. And, I try to give you the information, or at least help you understand the process that I'm going through and how I go about adjusting or managing these positions. So when I started the trade, I literally took in a 10-cent credit on a 10 lot, which was, a $100 credit. And my initial buying power was about $16,000, and that's in the portfolio margin account. As you can see on a 10 lot, my actual Reg T risk is almost 30,000. So using a portfolio margin does give us slight advantage here as far as leverage goes, but I wouldn't say, go all in, use as much of that leverage as possible. For me, with these kind of trades, I try to keep my Reg T, somewhere around 50,000, right? I don't want my Reg T risk exceed 50,000 unless I plan, to deploy larger amount for whatever reason, right? No two trades for me are identical. And I want to teach you guys to kind of understand and look at things the way I see it with these butterflies is that, look, for you, this butterfly may be too bullish, or maybe it's too far out of the money, or maybe it's too much risk to the downside, or maybe that's not enough credit to the upside. And it's all great, right? It doesn't have to be the same way for me or for the next person. You have to figure out what works for you and how you're going to manage the trade, right? And whatever you choose to do, that is the right thing to do. Not what I will tell you, but our process is going to be similar, right? Because if the trade gets in trouble, we're probably both are going to look for similar ways to defend this trade, right? Or if we're hitting certain targets, we can go through the same process of understanding, should we stay in this trade and look for maybe an incremental adjustment that's going to advance this trade a little bit more, right? Give us enough reward to justify taking the additional risk for additional amount of time. For example, in this trade, so I started with a very small credit up front. I knew that I can't just put this trade on and walk away and come back on the day of expiration, hoping that, the price is somewhere above the structure. Because if that is the case, I know that all I'm going to make is that small $100 credit on a 10 lot, even if my risk is only 16K. And I think over time, this BP requirement is going to change, and I believe that is going to actually increase. I'm going to take a look on my Schwab or Thinkorswim platform. This is a trade number 3003. So right now my margin in this trade is $16,236. And if I am going to go forward in time, let's say we're in this for 12 days, maybe another 14 days. So from the 16th to 30th. On the 30th, assuming we're still at around, and we're pretty far out of the money. On the 30th of this month, it looks like my margin isn't going to change much. It's actually going to be about $15,750. So it's not going to change a little bit. In some cases, if there's more time until expiration, it actually might increase. But I always use the Reg T risk as my planned uh, planned capital for the trade. That's not my risk. I'm not looking to lose the entire amount, but that's what, at least on the standard broken wing put butterfly, 50K. And how do we get to 50K? Right? Like, I know if I don't want to make it super complicated, right? I just want to be long a put debit spread and short a put credit spread. I'm going to make them uneven, and I'm going to keep the difference between these two spreads 50 points. So if this is 100 point wide, this is 150 point wide. If this is 20 point wide, this one is going to be 70 point wide. Right? The difference between these two is 50 points, which will be equivalent to a $5,000 margin for the trade, plus minus whatever you do. If you put on the trade for a credit, then that 5,000 is going to get reduced by the amount of credit that you collect. And if you do it for a debit, it's going to be 5,000 plus whatever you're paying for it. So for this trade, I took in a very small credit up front, and I knew that I can't just walk away and do nothing else. So as the market started to move higher, right? This was on October 14th. And again, you can look through the posts on Discord, right? On October 14th, I left a comment saying, I'm going to roll the wings in to collect a credit and unlock more upside potential. I moved my longs on the upside and longs on the downside closer to the body or to the center of this trade. I collected $1.15 credit, 10 contracts, which was equal to about $1,150. Right. So before I had a net credit of $100, I collected $11.50. That put my net credit or my tail profit at $12.50. All right. So $12.50. That's the most I can possibly make if I do nothing else. So that's my tail. And if I'm going to make $1,250, assuming that my margin doesn't, get crazy high. Right now, the margin is at around 16 and change, so let's call this 17,000. So if I can make 1250 on 17K, that's return on margin of about 7.35%. Right. And if it takes 2 months to get there, right, it's about 3.5% per month or so. Now, yes, the market could go down, volatility could go up, buying power can go up. So, this isn't written in stone that do this trade and you're guaranteeing yourself 3.5% a month. Things can change. I get that. Right. But that's the idea for right now. What I have to put up to hold this trade, it could potentially yield about 3.5% per month as return on margin. So from here, I know that 1250 is my max potential reward in the tail here, where let's say right now this trade is showing us 400. So that means there's about $850 worth of extrinsic value left in this trade. There's 65 days to go. Okay, so I keep holding. How long am I going to hold? I don't know. I can hold it until, the last maybe couple of weeks. If you're, I like to get out of these things before the 21 DTE. I don't want, and it all depends again in the context of, where are we? If SPX is at like 7,000 and my butterfly is at 5,500, and we're at 21 DTE. Do I really need to get out to avoid? Yes, I guess if you're looking for some kind of a black swan event where it's going to get the price back down from 7,000 to below 5,400, because that's where my break even to the downside is, right? If you think we're going to sell off 1,600 points in 21 days, then get out. You probably get out for as close to zero as possible, right? All of these options are going to be worth almost nothing, right? You pay a nickel here, collect a nickel here, and so on, right? So the idea is the higher we go away from the 10th, the less this butterfly is worth. So in the end, if we expire outside of the structure, all of these options are going to be worth nothing, and you get to keep whatever you have collected throughout the cycle of this trade. So I entered this trade for a 10-cent credit. I rolled the wings in. I collected another $1.15. So now I collected $1.25. And if I do nothing else and the price continues to stay above the structure, that is the most I can make, is $1.25. And if you really want to, use, instead of the margin requirement or BP requirement in the portfolio margin account, if you were doing this trade in a Reg T account, your broker would ask you for more than 16,000. You would have to pull up the full Reg T risk, which is currently at $29,900. So if I make 1250 on 29K, right, that's 4%. If it takes me 2 months to do it, so this trade will yield about 2.15% per month, and that's return on Reg T margin. So there's no right and wrong. You can use whatever metric works for you. Like, you can get really fancy. And the only thing I'm going to say about this, if you're going to use, Reg T risk as your baseline for return on margin, then use only Reg T risk. Don't, try to, for one trade, I use Reg T risk. For next trade, I use portfolio margin requirement. You just want to be consistent. Whatever you choose to write, it's your, trading business. You figure out what works best for you. I think using a Reg T risk will be a more conservative approach. You really truly understand, even though you don't have to put up all of the money in the portfolio margin account. If the market goes to zero and never opens again, your real risk in this trade is going to be a lot higher than what you're having to put up in the portfolio margin account. Your Reg T risk is your real absolute risk. However, right, even though whether you're using portfolio margin or a Reg T account, you have to put up full Reg T risk, that's not what we're looking to risk in this trade. We have to understand that, if we're going to make, 1250 in this, we don't want to lose maybe more than 2,000, right? So you want to keep your risk and your reward somewhere aligned where it actually makes sense, right? Is it 2,000? Is it 2,500? I know everybody wants, exact answers. I don't think there is one. But whatever you're going to make, don't lose, 7 times what you make on a trade, because it's just going to make it that much harder to recover from. It's a lot easier to take a smaller loss on a trade like this and move on to another trade. Because what tends to happen, right? So if you look at this structure here, do you think this is a bullish or do you think this is a bearish structure? I mean, if you know how to read a risk graph, right, this is a bullish to neutral to slightly bearish, right? Because we can go up from here, this trade will win. We can go nowhere, and this trade is still going to win. And we could go down to a certain extent, right? We can be down as much as, I don't know, 4% between now and expiration and still make money in this trade. One thing this trade doesn't want the market to do is go way down, right? If we're down 7, 8, 10% by expiration, this trade is not going to win. So you have to understand that if you take this trade, your near-term price outlook has to be at least stable. It can go higher, it can be go nowhere, or it could be slightly lower, which is, to me, fairly stable, right? Market goes up and then market goes down. What you don't want to see is the market go down in excess of 7, 8, 10%, because that's not just not stable. The market is clearly telling you that your assumption for the price, right? If you put this on, your assumption for the price is stable. Maybe it's bullish, maybe it's neutral. And if the market is going down 8, 10%, clearly the price is trying to tell you that you're wrong on your assumption and it's time to get out. You just have to figure out when is it time to get out. Now you can use charts, you can use indicators, you can use tea leaves, whatever you're going to use to understand the context, right? Like if you put on the trade and the market is going down and it's going back up and it's going down, right? Now you have 821 cross bearish. Hello, the price is telling you your outlook on price is wrong. Consider getting out before things get really bad, right? And this, now here we're looking at a chart of this is August. I had one of these trades on in August through the crash. And guess what? It didn't blow up. It was stuff. I actually got out of the trade, right? I wasn't fully scaled. I planned on adding to it, considering the market was going to be stable. When VIX went to 65, to me, that signals that market is not going to be stable. So I chose to close out a trade. And yes, I did take a loss, but the loss was like, I think it was somewhere around 13% on margin, which is really not that hard to recover from. I didn't lose 13% of my account, right? I was looking to make 10% return on margin. I lost 13% on margin. Guess what? It'll take me one potential winner to recover what it lost during one of the biggest blowups in volatility in recent history. So, I mean, that's again, and I don't want to go in that direction right now, but that's one of the benefits of having defined risk trades such as these, right? So again, you get to decide how you want to set up this trade. If that's not enough credit for you, okay, make this swing tighter, make this swing tighter where the difference is still somewhere about 5 points or 50 points on the SPX. If you're using SPY, you can use 5 points difference, which will be equal to a $5,000 margin requirement in SPX or $500 if you're using SPY. And by making your put debit spread narrower, you're spending less money. So your net credit on entry is going to be a little bit higher. But you get to decide. You are in charge of your trading, right? This worked for me. And I'm going to show you, this was a great question from one of our members about yesterday's trade. And this is the trade that I put on yesterday. Right, this one had 77 days yesterday. Hey, you want to trade these at 77 days? Great. You want to trade these at 14 DTE? Great. You do whatever works for you. So, but for me, as a guideline, I want to be somewhere, 65, 75, somewhere around, 2 months out, because I want to not do anything to this trade for the first couple of weeks, at least. If I took a credit of, $1.80 like I did yesterday, this is a 10 lot. So my net credit or total credit here was $1,800. I need to let some time run off the clock. I want to give it at least 3 weeks, right? And then once some time runs off the clock, we could get an idea if we can do something to this trade to make it a better risk reward, or maybe it's time to get out. And here I want to talk about, let's see, who was, this question came from Jeff yesterday, right? So like, how do you set up, looking at two different trades, one was set up a little bit closer to at the money. This one was a little bit further out of the money. What's the deal with that? And the deal here is, for this trade, what I did was I looked at the market expected move for 30 days out. I set up the trade 77 days away, but I wanted to see what was the market pricing in. And I know that, implied volatility is slightly elevated right now. And given that, election will come and pass and we, don't go into a full-blown civil war and whatever, volatility is going to contract, and it's going to make this and a lot of other short premium trades make up for what they may not be making right now. But I looked at the expected range for the next 30 days. So by um, November 15th, based on current implied volatility, this darker shaded area is what the market is pricing in. So from where we are right now, we're either going to move up or down, but we should expect to stay inside of the range between 60.25 down to about 56.45 or 56.40, whatever. Right. So what I wanted to do is I wanted to place my long leg of my put debit spread slightly outside of the expected range, right? For the next 30 days. And then from there, I wanted to have a 50-point difference between my spreads. So this is a 100-point wide put debit spread and a 150-point wide put credit spread. And I collected $1.80 credit for it. If that wasn't enough, I could have made this put debit spread narrower, which means that I would have a little bit more Reg T risk, but I would collect a little bit more credit up front, and I would probably start with a little bit more positive delta. So this is a 10 lot, and I have my directional exposure right now is equivalent to about 5 shares of SPX. So if SPX goes up 1 point, I should expect to make $5. If SPX goes down a point, I should expect to lose $5. Right. So the goal here, and by looking at the T plus 30, and again, this is all, projected is, this is not accounting for any potential volatility swings in the marketplace. But given this implied volatility where we are right now, let's say if we are somewhere inside of this darker shaded area, I will probably max out my potential profit here because remember the tail is my credit that I collect when I put the trade on. So the most I can make outside of the tent to the right is $1,800. If 30 days from now we're, let's say, at, I don't know, 59.50, and this pricing model is telling me that this trade should showing me a P&L somewhere around 1,800. I don't really have any more potential upside here, right? In 30 days. So with 46 days to go, if I'm maxing out my tail profit, I either need to make some sort of adjustments to make it worthwhile staying in this trade. Either roll the wings, sell call credit spreads, different ways to bring in additional credit. And if I'm not bringing in additional credit, then I just end up staying in this trade. This risk to the downside, even though it's pretty far away and there's only 46 days, but the risk is real, right? Can we move 10% in the last 46 days? Absolutely. We've seen that before. So if I'm not getting any more potential reward and I'm not collecting any more credits in the tail here, why am I holding this downside risk? Doesn't make any sense. So to me, that signals that it's time to make a move. If I'm going to consider several different adjustments. Maybe I'm rolling my long puts down and my downside longs puts up to collect a little bit more credit. I'm giving up some of this potential reward inside the tent in exchange for a little bit more credit up front. But if I'm only going to collect like an additional 20 cents on 10 contracts, I'm going to make another $200 and I have to hold for 46 days. To me, it's probably easier to make that $200 elsewhere, right, over the next 46 days. So I will probably, most likely, 90% of the time, I will probably just end up closing this trade. And I did just that. You can look at for your reference, look at a trade number 2995. I put the trade on, took an 80-cent credit, and then the market went, I'm not sure where it went, but I was able to add more. I'm guessing the market went down a little bit. I was able to add another tranche for $1.50 credit. Right. So I took in 80 cents, 0.8 plus $1.50. 50. 0.8 plus $1.50. 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 0.8 plus $1 divided by 2. So my average was about a $1.15 credit. It was a 10 lot with about, so I took in 1175. My BP on that trade, it was 30K. And then that was on October 1st. And then literally October 14th, I was almost maxing out on my tail profit with 46 days to go. I closed the trade for zero, nothing. I didn't pay anything. I didn't get anything else. So I took in the 80 cents. I added another tranche, collected another $1.50, and then I got out of the trade for even money. I didn't pay. They didn't pay me. I just closed out for zero. I was out. So I left the trade with 46 days with almost the maximum tail profit. All right. So that's kind of my way of thinking about these trades. And you know what? As long as the market is stable, and the market is stable a lot more than what we saw in August or August 5th, right? If you're always going to think about August 5th, then maybe you haven't fully recovered from that event. And you just need to keep things light just to kind of get back into and build on that confidence that the market doesn't explode. The market doesn't crash every single day. Yes, there is risks. You have to take on risks and you have to understand where your risks are. And most of the time when market's not crashing, these trades are pretty easy to handle. If this thing is going to go against us, again, we want to go back and look at the chart. What is the price telling us? Something changed? Is the market going down fast? Are we down 4% in 2 days? Are we down 4% in a month? Like we need to understand the speed at which market is moving and understand if we want to continue to hold. Because even if we were to pull back, 3.5%, 4%, but if it happens over, let's say, I don't know, 27 days, you can see that, again, given that volatility isn't going to increase drastically, but you can see that over time, our T plus zero is actually moving upwards, and we can get down outside of one standard deviation in 27, 28 days and still not be in a whole lot of trouble. Now, going forward from that point on, you do need to pay attention to the market because now you're getting much closer to your downside break even. And as you can see, the T plus zero line goes from being really flat to starting to really slope downwards on the way down, right? This is the function of short gamma, right? On the way down, your gamma is going to force your delta to increase exponentially to a certain degree, right? Because your downside risk is capped. But you can see that if we're down here in 27 days, now there's 49 days to go. Now the expected move is going to be somewhere between maybe 5,200 and 5,900. You want to consider, hey, do I want to continue to hold? If the market looks bad, if you have a bad feeling about the market, you can still get out for a small loss. But if the market bounces, okay, great. But if it goes much further against you, you also need to consider, how much pain are you willing to take before you need to say, all right, if we started the trade at 58.30 and now we're at 5,400, there's only one thing to say, that your outlook on price, remember, this trade is neutral to bullish. If we're down 7.5% in a month, price is not as stable as this trade needs. It's time to consider getting out of the trade. Don't be a hero. Don't try to protect your ego. Don't look for reasons to not stop out of the trade, because guess what? If you stop out with a small loss and set up the same exact trade, your tenth is going to be much further out of the money. It's going to be a lot easier to manage the trade. Right. So right now I have just these two trades going. I closed one out just a couple of days ago and I replaced it with another trade. So I closed the trade with 46 days and I initiated a trade with 77 days. That's what I did. And here's where we are. This trade was put on 1 day ago. We had moved just over a half of one standard deviation, was showing a small profit. Okay, great. And also, I saw somebody post earlier today that they put this trade on for $1.90 credit, and they tried to get out, right? The mid price right now is about $1.70. So they're trying to get out for 10% of credit. I guess you can look at it that way. But then how do you measure your returns? Let's talk about returns for just a quick minute, and I'm going to let everybody go. This is a 5K per one lot trade. The difference between these two spreads is 50 points. That's $5,000 for SPX, $500 for SPY, minus the credit, minus 180 or 190, whatever you're collecting. So let's just do 5,000 minus 1,800. That's 3,200. So right now, Reg T in this trade, right? Reg T in this trade is 50 points minus $1.80. Sorry, 50 points minus $1.80. That's 48.20 times 100. That's Reg T per one contract is 4,820. So you have to put up $4,820 in a Reg T account to collect that $1.80 credit. So let's just remember this number, 48.20. Let's say we use that for our measure of return on risk. So 48.20. And if you're going to get in for $1.90 and then get out for $1.70, right? You make 20 cents times 100. That's $20 gain on 48.20. And it's, about a half of one or 4/10 of 1% return on margin. I mean, it's not crazy, right? You divide that by, or you could multiply that. If you can do that, every day, which is probably not realistic, but it has a annualized rate of return of like 150% or something like that. But you're not going to do this every day, right? Because if you make $20 and you consider the fees and exchange fees for SPX contracts, it's just not worth it, I don't think. So I think that the goal here is, right, I measure return based on risk, either portfolio margin requirement or Reg T. The idea here is to make 10% return. Am I always going to make 10%? Probably not. If I can get 5% in half the time, I'm getting out, right? Because I don't want to hold this trade as close to expiration as possible to test my luck to see if I'm maybe going to hit this. I don't care about this tent, right? I'm happier with the tail profit because if I make 1,800 and right now Reg T risk in this trade 48,200, right? So we divide 1,800 by 48,200. That's about a 3.7% return. Over 77 days, it's about a 17, 18% a year rate of return. But, you can say, well, that's nothing, it's not good enough. Okay, then maybe you need to structure your trades where you're taking in more credit. Maybe you're placing your structure further out of the money. Maybe you're putting it closer to at the money and then change the wings in a way where credit versus requirements makes more sense than, doing this trade for a 17 or 18% annualized rate of return. If we're, and this is, I think this is conservatively looking, right? Because we're measuring credit against the Reg T margin. If you do this trade in a portfolio margin account, assuming your portfolio margin requirement will never go as high as what the Reg T risk is. I think this trade right now takes up, this is 30.32. This 10 lot right now takes up just under 26,000. So now, assuming if my requirements never go higher than where they are right now, if I'm going to make 1,800 on 26K, now it's a 6.92% in 77 days, right? Or if I could get out of this trade, just like I said before, if I can get out of this trade in 30 days, right? This is my T plus 30. If I can get out of this trade with close to my max potential or the tail, maybe I'll get out for 1,700 profit. 1,700 on $25,000 of buying power requirement. That's 6.8%. If I can get out in 30 days, right? So we divide that by 30 times 365. Now you have an annualized rate of return on portfolio margin requirement of about 82%. And if we're going to use that same Reg T risk for our measure of return on margin, if I'll make 1,700 on 48.2, over 30 days times 365 days, that's almost a 43% annualized rate of return on Reg T risk if we are able to capture almost full tail profit in the first 30 days. Me Too says these are hard to fill. They are hard to fill for, I, I don't think they're hard to fill. That's one, if your price is right. Now, remember, we are playing their game. They meaning the market makers, right? We come to the market. The market didn't come to us. So if the fair mid price, and this is according to the mid prices of all four legs that are part of this trade, if a fair price is $1.80 credit and you're trying to get in at that price, well, the market maker says, you want me to take the other side of this trade? I don't think so. I'm not saying they're going to ignore you. They just don't have the incentive to jump on this trade. It's not as attractive to them, right? So either you have to give them a better price, ask for a little bit less, drop a nickel, go to $1.75, or wait. And wait for what? You wait for the market. For example, I was at $1.80 yesterday for not too long. I put the trade on, I entered, and then probably within 7 minutes, 10 minutes tops, I was filled because the market was coming down. And if the market is coming down, as you can see, the P&L is getting worse, which means that the price of this trade or the credit for the trade is going higher. So if you entered for $1.80 yesterday and you didn't get an insta fill, and you waited a little bit as the market sold off, now the market for, or the fair price for this butterfly went from $1.80 to $1.90. And if you still had the 180 ask for this trade, then you got filled, right? So they're not hard to fill. You could look at the mid price and try to get in, a nickel within the mid price. Again, the market makers didn't come to you. You come to the market. You want to play their game. Mid price is $1.80. It doesn't mean they're going to jump on it. But if you stay somewhere within that mid price, they're in the business of making trades. They'll eventually take the other side of this trade. And SPX, you can look at the bid ask and you can say, oh, the bid ask is so wide. Considering this is a $5,835 vehicle, the bid ask spread is not crazy. It's one of the most liquid vehicles out there, SPX options. May not be as liquid as SPY, right? Because you have a lot of retail traders in there. SPX is used by the professionals, and if you want to look at the volume of SPX options, we're probably at all-time highs right now. So SPX options are continuously gaining traction, and there's more and more interest in trading SPX options, which is great for us. Just going to make things a lot more liquid. All right. So hopefully I gave you some insight. Hopefully I gave you something to think about. If you have questions, you can always post your questions on Discord. I'm going to let everybody go. I'm going to wish you a great rest of the day. If you have questions, put them on Discord. I'll be back on Friday. We're going to talk about some 1-1x income trades, slight variation, something um, for everybody, I think, that are looking to generate income. Another variation. I think you guys are going to find this pretty interesting and hopefully helpful. So until then, have yourself a great day. I will talk to you guys next time.